Hey guys, Money Max here. We're back with another video. So welcome to part 2 of why you will not make it in 2021 without knowing this skill. All right. If you haven't watched part 1, I advise you to pause this video, go back to part 1, feed on the information, take in everything I'm saying. Make sure you like, subscribe, comment, put a thumbs up. It helps me get this out there to more people. Okay. So in this video today, we're going to take it a step further into looking at what this skill is, why you need it, and how you can start applying it today. So I hope you guys enjoyed the video. Let's get on with it. Okay, guys. So I'm back with BTC again. The major focus of the crypto market right now is BTC or Bitcoin. And this is simply because of where we are in terms of the market. We've had a lot of news come out around Bitcoin, from El Salvador adopting Bitcoin to fears of Bitcoin having massive environmental impacts now and in the future. So we've had quite a topsy-turvy period of time when it comes to the fundamental side of the crypto market and primarily Bitcoin. All right. But as I said, there is a way to survive what's going on when it comes to crypto, but it will require you to have this skill that I've been talking about. If you don't know what this skill is by now, you should know by the end of this video even further. Now, the skill we're discussing is technical analysis. Without technical analysis, there's no way that you're going to be able to survive in the crypto market. In fact, in any financial market from this moment on moving forward. We've just come out of a major period of time where money has shifted hands with the coronavirus period. And so if you don't know how money moves in the market, which is what technical analysis teaches you to do, or true technical analysis should teach you to do, then you definitely want to make sure you know where money is moving. Why? Now, if you watch part 1 by now, you know that there are 3 levels to money in the market. We have the retail level, which is the majority of participants. Then we have institutional levels. And then the third level is governmental levels. And all of these levels have different levels of money, access to equipment, access to information. And as you could probably guess already, the retail traders, which is the individuals, you and I, are at the bottom of the barrel, which is the honest truth. It will never change. It will always be that way. Now, in 50 years' time, 100 years' time, if you're not in that top rank, there's certain things you would not know unless it's leaked. But even by the time it's leaked, it's still too late. Okay. So recapping now. All right. We discussed Bitcoin. And if you remember what we discussed, we talked about the difference between bad buying and good buying. Now, in a bull market, all right, what do we want? We want a bullish market structure. We want bullish market structure. Now, bullish market structure, again, we have 4 points here. Now, by the way, I'll put this out here. If you really want to have even more understanding and take your levels further, and you want to actually start doing this and reading the charts, and you want to have further learning, all right, I have a free course. If you follow the link in the description below, it's called the Mastermind course. You can get it on the Wealth Group Academy website, which is my company. All right, it's a simple 4-part series where I go into detail about what I'm teaching right now, okay, in another aspect, which is also important for your learning. However, you still need these videos in support with those course materials there for you to really get the grasp of this. So I hope you guys enjoy it. Follow the link beneath and get yourself started. Okay. So where are we right now? So this is the market structure of a bullish price pattern, if you want to call it that. Okay. When the price is moving in a bullish direction, which means that we have succession of upwards movements, we have a bullish market, or the price is increasing. Okay. And this is the normal harmonical structure. Now, the harmonic structure of something just means the structure of how the price moves, but this is the harmonic structure of how price moves from one point to another. So here is our A to B here. And here's the C. And here is the D. Okay. So now the opposite of a bullish structure here. So this is the bullish structure right here. I'm going to put this here. So bullish. Okay. You can call it a bullish trend. Okay. Another term for it is an uptrend. Okay. All right. So now when you have a succession of bullish trend movements, okay, now a complete cycle. Now, this is important. I'm going to write this here. Even though I'm saying this, I want to write this down. So for those of you who are more note takers, you can take some notes here. All right. Now, a complete cycle of price, all right, has 4 parts to a full cycle of price, which is called a trend. Okay, so a complete trend, all right, has 4 cycles to it, or 4 points to it, which we call swing points. So if you think of a normal swing, a swing is one of the most important things about a swing that makes it fun is that you shift from one momentum to another. So you go from one point to another point. Okay. So for a swing, we have a moment where we're balanced, and then we go from one side back down to the other side. And this is what we call swing points. They're simply, in the most simple terms, if you've never been involved in trading, is the point where the price changes direction from going upwards to going downwards. Now, these key points here are the points where, as an investor or as a trader, you want to have your eyes on to, number one, capture the best entry if you're trading, and if you're investing, to capture the best price point for your dollar cost averaging. These are the things that you'd want to do. Okay, so this is one of the things that are important. Now, the opposite would be what we call a bearish trend. Okay, a bearish trend. Okay, or a downtrend. Okay, if you want to keep it simple, you can call it a downtrend or a downwards trend or upwards trend. Now I need to change that because that doesn't look right. Okay, so we have a bullish and we have trend and we have a bearish trend. Now, when we have continuous cycles of this movement overall, so I want to put this as a prerequisite for those of you who are investing or trading. There is going to be a time where your account not necessarily be in minus, but there'll be a time where you'll be in what we call drawdown. And all drawdown really means is that period of time when, let's say you bought somewhere around about here. I'm just going to put a mark here. So say you bought right here, and then the price drops down a little bit lower than where you first entered from. So you're starting to lose a little bit of your portfolio, but that's part of the game. Over time, okay, you will gain. And this is the same thing when we go on the Bitcoin chart. Let's correlate this here. So again, if I was to pick out an area of where A could possibly be, if we took it from here, here's A, all right, here's B. And you're not too sure where C is, but if you're looking at the full picture, you know where C is. But let's just say that you bought even, let's say right here. Now, where you bought right here may even be scary because this is 2008. Where you bought, as soon as you buy in the next month after, the price drops quite a bit. Okay, but this is what we call drawdown. But you see, over time, the price recovers and they end up being back in profit again. All right. So when it comes to observing and investing, okay, price does matter. All right. You want to get in at the best price point because you get more profit, as I explained and demonstrated next week, which we won't do right now. But also, it allows you to be able to position yourself to have the best opportunity to make money. Okay. This is what we want to do. You want to make money, not lose money. Okay. But drawdown is a part of the game. So for those of you who say, I want to get into trading, I want to get into investing, but I do not want to lose, then you're setting yourself up for disappointment. This is probably not the right game for you because there's going to be a point where you do make losses. Okay. Or you are in a losing phase, but it's only temporary. But that's only if you follow the rules. If you're in a losing phase, but you haven't followed the rules, then even I will be afraid for you. But if you follow the rules and you're in a losing phase, then you shouldn't worry. It's just a part of the game. Okay. All right. Not every trade and every investment, as soon as you buy it, it does 10x. All right. If you're led to believe that, which is what a lot of traders and investors sadly do believe, then you're in the wrong game. Okay. You will take losses, but it's about your overall gains over the long term. Okay. It's about the longevity of things more than just for the now. All right. So this is where we are now. Let's take this a step further now. What drives the price to move in these directions, if you're wondering? So if we go from A to B and then from C to D, what makes the price at B go back down to C? And why does the price stop at C and go towards D? Now, for that, my friends, I'm going to introduce you to part 2 of this skill that you need to understand. All right. And the aspect that you need to understand technical analysis, I'm going to open up this new chart here and we're going to demonstrate this right now. It's called supply and demand. All right. I'm going to write this up for you. Supply and demand. All right. And I'm going to put here the cause of price movement. Now, there's a better term for price movement called price action. Okay. But I'm keeping it very simple and basic. So we're just going to call it price movement. Now, what is supply and what is demand? Okay. Now, in the market of trading, in any market, Forex, crypto, stocks, all right, there is two driving factors primarily that cause the price to move. Either the price moves in a bullish direction, okay, which would be supply, or we move into a bearish direction, okay, bullish direction, which, or a bearish direction. And the bullish or bearish direction that we move into is caused either by supply or demand, okay? Now, if you want to think about this, the best way you can think about this is, and I'm going to put this here. Now, let's say you're part of a market, okay? And let's say in this market, we have one person here. All right. I'm going to put this right here. So this is our item, okay, guys? You stick with me for a moment and you understand where I'm coming from. So I'm drawing out a box here. And this box, we're going to call it a special item. All right. So I'm going to put in here, I'm going to call this item 1. Okay. So item 1 is an item that everybody wants to have. Now, in terms of supply and demand, if any of you have ever been to a fresh foods market, okay, where I'm from, we have a fresh foods market called Dalston Market, and it's a place where you're either buying something or you're selling something or both, okay? This is what a market is. So, you know, when we talk about the financial markets, it sounds very complex and very deep and brainy, but all it really means is a place where people are buying and selling consistently, 24/7 on crypto anyway, 24/5 for most other markets. Okay, people are buying and selling some sort of asset or some sort of physical thing at different price rates. Okay, so this item, if we're in the market and I said to you, okay, if one person, and you have to follow me through to understand, if one person had this item, all right, and let's say down here, this is going to represent all the people who want to buy. Okay, so I'm going to put an arrow pointing forwards. Okay, and this means that we have a demand. Okay, so when there's a demand for something, people want something. Now, for when you're looking at market or just simple economics, if something is in demand, all right, and many people do want it, as a market person, the wisest thing you can do is increase the price gradually over time. Why? Because there's such a high demand for it, you can actually ask more for that item because people need it. Because there's a human need attached to it, or there's a need at in some cases and a want, without going too deep into things, but there is a demand for it. People want it. Okay, for example, let's say electricity and gas. Okay, now your service providers that provide you electricity and gas, they're vital necessities for human living. Okay, unless you've been trained to be able to live in the in the desert or in the forest or anything like that, or an outdoors person, primarily 99.9% of people that live on the earth right now, okay, do need gas and electricity to be able to live the human life that we live in 2021, okay? Even though not everybody has that, but that is supposed to be a standard that everybody has. Another one, clean drinking water, okay? So all of these services require cost money, of course, to provide, and therefore it costs money to be able to have. Now, because there's a consistent demand, the amount of humans in the world are increasing daily by the second. Okay, that means that there's more humans, so there'll be more demand for these resources, and therefore, because there's more demand, companies over time will increase to be able to gain more profit from the demand and also be able to pay because things get more expensive over time as well. All right. So this item here, let's say we have 3 people, all right, who demand. So I'm just going to pull it demand here. All right. So item number one, we have three people who are demanding this, and we only have one supplier. Okay. I repeat, we only have one supplier. Now, if you're the only person in the market, or you're the only person that has something, okay. Now, for those of you in crypto who are more savvy, things that are you can only have one of those, like NFTs, drive a lot of value because they're one of one. They're irreplaceable. There's only ever going to be one. Okay. They're non-fungible. And so therefore that means, okay, they drive a lot of value. Okay. For those of you who might be struggling with understanding this, think of antiques. Okay. An antique item, okay, is not just the same as every other item. You can't get it again. It has value attached to it, sentimental value, and etc. Now, in a simple market, and in this case, if I was to put this as the only supply here, this supplier can charge, big bucks. Okay. So I'm going to use some pound signs because I'm from the UK. So if I put some pound signs here, he's charging some big bucks. All right. Let's just call that this item cost £100. All right. Now, other people are watching him saying that, man, this guy gets all the customers. He makes all the money in the market. I want to get in. So a few people, if you really want to muscle in on his business, do research, buy the item themselves, try and find a way to find out where he gets it from so they can also get the item from him. All right. So then item number one now, what happens? We have an increase in supply. So let's say we have two more suppliers who find out where to get this product from, exactly the same price also, okay? And they start selling also in the market. Now there's no law against that at all. The item hasn't been, you know, copyrighted or something, or there's not been any patent put on it. If it had a patent, then it's different, but there isn't any patent put on this item. So it's free for anyone to be able to buy and to sell. Okay. So this is supply. In fact, I'm going to change it from supply. All right. And I'm going to call it supplier number one. So supplier number one was the only person with this item and they were able to charge, big bucks. All right. Then supplier number two comes along and says, hey, I also sold this product too. Okay. All right. And then on this side here, if I bring this up, we have supplier number three, which is the other supplier who also found out where to get this item from that everybody wants so much. Okay. Now, if you correlate this to real life, you could think about, if any of you remember that, should all be able to remember that. It's quite recent. But do you guys remember those spinning top things that everybody has? I forgot the name of it, but it was like kind of looked like a starfish that you could spin. You can spin it around and it lights up, and that's all it really does. And there was a crazy craze on it about 4 or 5 years ago, where everybody was trying to sell these spinning things, and people made 50,000, 100,000 selling very small. I'm gonna find a picture. It's gonna come up on the screen in a moment. But very strange item, but everybody seemed to love it. So coming back to this anyway, we have two more suppliers now. Now, remember, guys, let's add some numbers in here. I'm going to write this down. The wholesale price, or let's just say before we get to the wholesale price, the market price, which is based on supply number one. I'm going to put the market price. Let's make it easy. It's £100, okay? This is the market price that the supplier is selling at. Now, let's forget about the wholesale price for a moment. Now, you can ask yourself this question and it will help you to understand supply and demand. And then we can leave from this example. If supply number two and supply number three also sold their product for £100, okay, they will get some customers because maybe it might be based on convenience. Maybe they might be a bit closer to the bus stop, I don't know, or they're closer to, as soon as you walk in the market, they're a bit closer by. So people might just turn in to get the same product instead of going to their actual supplier. But then what does supplier one and have over two and three? Trust. He's been selling these this item for the longest. Okay, people know him to be the one who sells it primarily. So these new two guys that are coming along, there might be some distrust. There might be a few things. So the majority of the demand, the majority of the money coming from customers who want this product will still be going to supply number one. However, he will lose some demand because people will go to supply number 2 and 3 for different reasons. Maybe they're closer, maybe they know them too. Who knows? Okay. Now, what is the only definite way to get to kind of beat the competition, supplier 1, and for these two guys to basically be able to get some of this demand? The answer is, and I'm going to write this right here for you. If you answered it before I said it, please leave a comment below what you think. All right, and tag the minute that I said it or tag the time frame. He has to lower the price. All right. So supply number 2 and supply number 3, he or she has to lower the price. Why? Okay. Because when it comes to loyalty, okay, in terms of market, human psychology and human behavior, if supplier 1 is selling this product for £100 and supplier 2 decides, okay, I'm going to take 20% off. I know I'm cutting myself out of the profit. Maybe I'm going to make less, but in the long run, I will make more and build a bigger customer base. I'm going to sell it for 20% cheaper and I'm going to sell it for 80%. So what's going to happen is that the demand, now demonstrate this with the arrow, is going to start to point a bit more further towards supply number 2, because supply number 2 is saving everybody £20 and nobody wants to give out an extra £20 for the same product, especially if it does the same exact thing or it has the same exact benefits and etc. Okay. And then what's going to happen here now, supply number 3 sees that supply number 2 has dropped his price to £80. So what is he going to do? He's going to say, all right, I'm going to drive the demand now, because he's noticing supply number 1's getting a few loyal customers. Supply number 2 all of a sudden is killing the game. And supply number 3 is left over here wondering what's going on. Hardly anyone's coming to the shop to buy anything, and they're not buying his product too. All right, so he does a massive sell. He says, all right, guys, I'm going to do 50% off. So he starts to sell it for £50. Maybe that's the wholesale price too, but he doesn't care. He's just trying to get the demand to switch back this way. So when he does this, what happens? The demand switches right back over to his side, and we see that the price action would follow that the price has become what? Cheaper. All right. So the demand has been driven over to his side because the price is cheaper, and people are thinking, wait, 50% off? No way. Forget supplier 1 and 2. I'm going to this guy. And this is where price competition comes in. Now, how do we translate this into supply and demand? Now, I know that most people listening to me have at least seen one trading video, at least. And if you haven't, then well done for listening to this video. But there is, much debate as to how the price moves. Now, supply and demand, okay, for me as a trader for the 6 years I've been trading, is the engine of price action. The reason being is because we're looking at the money in the market, okay? What drives the price, okay, upwards and downwards, is how much money there is on the buying side of the market and the selling side. Now, without going into deep depths about market order books, okay, if we take this over into trading terms, okay, I'll write this down here for you. The more supply, now supply translates in the market, okay? Supply means, okay, selling pressure, okay? Supply equals to selling pressure, okay? All right, and this will equal to a reduction in the price, okay? If there's a massive supply, so in other words, if something is more common, all right, if more people can, if there's more, even though there's one item, if more people are providing this item, it becomes less of a rarity. This is just human psychology. If there was only, 5 airplanes that exist in the world, all right, I promise you that airplane tickets will be 100 or even 1,000 times more expensive than what they are, okay? Because it's more of a rarity, it's not so common. And this is just human psychology, all right? So in the markets, supply is the selling pressure in the market, and this causes a reduction in the price, all right? So when there's increased selling pressure, now another way you can say this is that selling pressure, all right, equals to bearish pressure, okay? Which means selling liquidity, all right? So you're gonna have to practice this and say this to yourself. So supply equals to selling pressure, which means a reduction of price in practical terms. But selling pressure equals to bearish pressure, which means we have selling liquidity, all right? Now, I guess you guessed it already, but the opposite of supply is demand. Now, the more demand there is for some goods or services, the higher the price will be over time. Okay. So demand equals to buying, write this here for you, buying pressure, which equals to a reduction. I was going to say a reduction of supply, okay, but that's too complex. Let's make it simple. An increase in price, okay? Now, for those of you who are in crypto, you would understand this a lot better if you've already been involved. If you haven't been, but there is a term called scarcity. Now, let's think about Bitcoin for a moment. Why is Bitcoin's value so high? I can assure you it's not because Bitcoin is just the first cryptocurrency to be created. It's because of the what we call the maximum supply. Okay. Now, before I move forward here, let me type this out for you. So buying pressure equals to bullish pressure, which is equal to buying liquidity. Okay. Now, liquidity, it means how much money is in circulation in flow. All right. And this is why I trade supply and demand. And I will explain the difference between supply and demand and support and resistance. Okay. Because I know many of you right now in this video are wondering, hey, but I trade something called support and resistance to buy and sell. Don't worry, I'm coming to you. All right. Now, if we go back to Bitcoin here, now Bitcoin, all right, has a maximum supply of 21 million. Okay. Now, the reason why Bitcoin's price is so high is because there's a lot of money, okay, in the system. The market cap at the moment for Bitcoin, I can grab it right here. So the market cap of Bitcoin at the moment, right here, according to CoinMarketCap, I wanted to make sure I have this accurate and live. So looking into today, Bitcoin's market cap is 613.78 billion dollars. Okay, so market cap of Bitcoin is 613.78 billion. All right. So the price we get right now would be how much is the maximum supply? Okay, divided by the current market cap, or how much money is in the system. Okay. This is important for you to understand when it comes to Bitcoin, why some cryptocurrencies have less than a penny in their value, but yet they have a very high market cap. Okay. Or they're a few dollars, but yet their market cap is 100 or 200 billion. It's also got to do with how much tokens are in circulation. So the more tokens there are, the smaller the price would have been for Bitcoin. Okay. So this concept of scarcity, please keep this in your mind. I'll be using this in several videos to explain to you how to develop this skill and avoid calamities that are going to take place in 2021 and further on. Okay. So moving back over to where we are, we have supply and we have demand. Now, how do you map out supply and demand on the market? Well, again, supply is the area of selling pressure. Demand is the area of buying pressure. Okay. Now, what I want to do is I want to clear up the difference between supply and demand and support and resistance. Now, support and resistance, okay, in the foundational term, is areas where the price, for example, right here, areas where the price seems to be supported or the price seems to bounce off of to continue going in a bullish direction. Okay. And resistance would be areas or price levels, specifically a specific price point where the price seems to, for example, here or right here, where the price seems to bounce around and not be able to continue going further from that point, no matter how much times the price bounces. So this is support and resistance. Now, the simple way to put this to you is that what drives the market is not a specific price point. Okay. So the reason why I don't trade support and resistance, not that it doesn't have some use. Okay. When I trade support and resistance, I use support and resistance to see what retail traders are thinking, because currently the education system for trading, especially things like Forex and crypto, primarily people do use support and resistance to trade. So for me to get ahead, as I told you about the retail trader chap, the algorithms that control cryptocurrency are very familiar with support and resistance, and even create fake support and resistance levels themselves, which traders go on to trade. And when you trade those levels, you get stopped out and you lose a lot of money, especially people who trade things like Bitcoin's futures or any sort of leveraged instrument with any exchange. All right. So I use support and resistance. I don't mark them off, but I just use them to note, identify where and how traders and what they're doing and how they're behaving in terms of their mindset on the market. Okay. Now, I like to use it, and if you want to use support and resistance, you can do. But my only warning, if I'll be really honest with you, is that support and resistance doesn't really capture what the liquidity in the market is. Where is the liquidity? Now, what drives the price, okay? The same way what drives the price in a normal market with an item, what drives the price upwards and downwards, okay, is what the overall supply and demand is. Okay, so I'm going to put this right here for you to understand in more detail, okay? I'm going to write this here as a statement. If the net liquidity, okay, in the market, and I'm going to write something here beforehand, is for sell orders. Okay, this is important. Now, before I move forward, now, when you buy or sell something in a normal market, all right, you're placing an order. Like if I say I'm going to buy something, I'm placing an order. So in the same time in the market, whenever you invest, whenever you trade, you're placing an order. Okay. Now, the liquidity in the market is made up of sell orders and buy orders. Now, the size of those orders, the amount of those orders, all differ compared to who you are, how much money you have, and what level of in the three levels I've discussed you are. Now, if the net order book liquidity in the market is for sell orders, okay, this will equal to supply, okay? So in other words, we have supply is greater than demand equals to supply, all right? So I'm going to put therefore, we can say supply is greater than demand. And in that case, the market will or will be bearish, all right? So this is very important for you to understand. If the net market order book, now the market order book is the ledger that keeps all of the information and balances the buys and sells. Remember, when somebody's selling on the market, somebody's buying, okay? And the market order book, the algorithm that control that, because no human could physically do so, make sure that these buys and sells are kept in balance. And hence why market manipulation is very easy to do, okay, with these algorithms, because the people who are in charge of them need to make sure that they have the preference over everybody else, okay? So what would demand then be? So I'm going to write this here. If the net order book liquidity in the market is for buy orders, okay, then what would happen? I'm going to write this right here for you. This will equal to demand, all right? So equals to demand. Now, what happens when it equals to demand? This means, therefore, demand is greater than supply. The market will be bullish, all right? So if the market is bullish, so what causes the price to do what we saw before, that A, B, C, D movement up, is going to be demand. Now, you can quantify supply and demand into what we call zones, okay? And these zones is what I'm going to show you today so that you can start to pick them out and use them to your advantage, okay? And then I'm going to analyze and we'll call it a session. Okay, so just to recap, if the net order book and liquidity in the market is for sell orders, that means that the market will be in supply and therefore the market will be bearish. Now, please note, supports and resistance, we're identifying a specific price area or a specific price point. Now, there's no specific one price point that can be a support or resistance area. because on a market order book, there are many orders coming in at different price points, sometimes down to the 10,000th to the 100,000th of a penny. Okay, all at different orders depending on where they are in the world, depending on how much latency, which is how much speed they have in connection to the market. And therefore, there's not going to be any order that is going to be this at the same price. Even if you place an order on the market, for those of you who place on certain exchanges, or if you are in the stock market, for those of you who trade stocks or stonks, as they say, you may know this a lot better. Okay, level 2 data. Now, when you make an order, okay, sometimes your order gets partially filled. Even though you choose a price point, if there's not enough sellers willing to hand you over that price point for you to buy that stock, then you won't be able to fulfill your complete order. And it's the same for Forex and it's the same for crypto. It's just that you can't see it because the order books are hidden. Okay. So when we therefore look at supply and demand, we need to observe this and use it. Now, support and resistance, as I said, can be used to observe how retail traders trade so that you don't get stopped out with them. But in terms of what causes the price to move upwards and downwards is the liquidity of the market that matters. Okay. Now, let's move forward and have a demonstration of how exactly to do this. So I'm going to open up Bitcoin one more time and let's have a look at how to use this tool. All right. So very simply, what is supply and what is demand? How can we quantify it? Well, very simply, first thing that you need to know, all right, and I'm going to write this here, is that for supply, a supply zone, okay, is the last, and this is important, bullish candle. Now, I know we're talking about selling and we have buying here right now. Sounds confusing, but you understand. In a trend, and I'm going to put in an uptrend, and I'm going to put the second line here. So first part is the supply zone is the last bullish candle, all right, before in the uptrend, okay? That's the first thing. Now, to attach that to the second part, what is the second part here? The second part is the last bullish candle in an uptrend, and I'm going to put in capital before the price changes direction, okay? Or you can call it momentum if you want. Well, let's just keep it simple, okay? Changes direction, all right? So this a supply zone, okay, is the last bullish candle in an uptrend before the price changes direction. Now, my charts may be different from most charts. Most default charts, bullish movement or upwards price action, the candles are green, okay? In my case, they're blue. And when things are going downwards, the candlesticks are red or bearish. So let's talk about demand now. What is demand? Okay. So demand is, all right, as we know, is responsible for the bullish pressure, the buying pressure. A demand zone is, let me put this here, a demand zone is the last bearish candle, okay, in a downtrend. And this last bearish candle is the last bearish candle before the price changes direction. All right. So I've just copied it here. So the key here is that these zones are the triggers for a change in direction, which is what we want. Okay. So if I was to put this into an example here, let's talk about a bullish trend. Okay. Because the talk right now, everybody says that we are in a bull market. Okay. Or we're supposed to be in a bull market anyway. All right. So if I start out again, now each of these points where the price changes direction, we call these swing points. Okay. So from A to B is one swing. From B to C is another swing here. All right. And then from C to D, we have another swing here. Now, even though the price changes direction, we always need to know what is the cause of the change of direction. Okay. Now, the change of the cause of direction will always be, all right, when there's a difference in supply and demand, or when we have a change in supply and demand liquidity. So how would I explain this? So let's talk about a bullish trend. So what's happening at A? At A, all right, for the price to go upwards, for there to be an increase in price, the demand on the market, or the number of orders in the demand side, and now specifically not the number of orders, but the liquidity, the amount of money on the buy side of the market has to be greater than the sell side. Okay, so in other words, as some of what we say in the trading community, the bulls are in control. All right, so the demand is greater than supply. Okay, so at A, when the price is going upwards, what this tells us is that the amount of liquidity on the market order book, or in terms of the market orders, is higher for buying than it is for selling. Now, what would happen here? We have the reverse. So in this case, I'll cut this away. When we get to the B point and the price starts to drop, and we get a decrease in price, supply now is greater than demand. Okay. So now the price continues to drop and is dropping and is dropping. And for those of you who are not savvy with or have any technical analysis, it looks like the world is going to end. Okay, but this is natural. In every bullish movement, there will always be a pullback. Now, the reason why there's pullbacks are for different reasons. One of the biggest ones is because, think of it for yourself. If the price, if you bought down here, let's say that this was 1p, all right, and then the price gets up to £1 and you put £100 in, you've just made 10K. So you're going to want to sell. But there's not only you that wants to sell, there's millions of other market participants who probably want to sell, and other people who want to buy and other things like that, because they've seen the price increase. They're thinking, well, I need to jump in. This is going to go straight to the moon, which it does, because after B, the price drops down and pushes here. But the distance between here and here, there is something that happens after, and we call this a retracement. So we have demand is greater than supply, and the supply is greater than demand. Now, when we get back to C, the point when the price goes from this bearish movement, downwards trend, back to an upwards one, would be where, again, demand is greater than supply. But for demand to be greater than the supply, there has to be a trigger, okay? And at this point, we would say that when we get to D, we should expect the price to continue doing the same thing. Now, last week, I went through it in more detail. When we have a complete cycle of price, C becomes our new A, and D becomes our new B. And we're going to continue this cycle until the price changes completely, which is for the next video, not for this lesson. How do we know when the price is completely changing from one direction to another for the long term? Which as an investor is very important to know. And so as a trader too. All right. So now, in order for the price to change from one direction to another, there needs to be enough liquidity on the buy side, which is stronger than the selling side. Now, we call these zones supply and demand. So at the A point, I'm using lines, but we can talk about the candles now. At the A point, or our swing at A, there's going to be a demand zone formed here, which will be the last bearish candle in this case before the price changes direction. When the price comes back into this area, this will be the optimal area for buying, where the price dips back in. Why? Because this is where the liquidity is for the buying side. Now, if it's not strong enough, of course, the price will drop and go further down. But this is the origination, or the area where the price, this zone of price, or this range of price between here and here, is where the heaviest concentration of demand liquidity will be. Therefore, if the price dropped back into this area, then you should be looking for a buy trade or investment to buy or a cheaper price. Okay. Now, how can we correlate this to the charts? All right. So I'm going to go over, let's have a look at Bitcoin. Now I'm using the weekly time frame. And now you tell me if you guys can spot this. But if I start from here, let's say we have A right here, somewhere down here. And now we have a B up here. Okay. Now at this C point down here, the price gets back into this area. Okay, right here. I'm going to label this as C. And then after that, from here, I've put D. We need the C. After that, the price goes and takes off and gives us a very strong D. Now you could use D as up here, or you can use D over here. Okay. For the sake of this video, I'm going to use D as where I had it last time, as right here. All right. Now, When the price went upwards here, let's start from this C point. Look at what we have here, guys. We have a very strong bearish candle. This is a very big red candle. Now, if you guys remember what I said, for the sake of teaching, what did I say? When we have a complete cycle of price, A, B, C, and D, then our C becomes our new A, all right? And the D becomes our new B. So in fact, if we're looking at the price action, we're going to pay attention to just the price action from here. This represents 2020. Now, if you're not too sure what these lines have meant for the whole time, on the weekly or monthly time frame, from one line to the other line here, these perforated lines, it means 1 year's worth of price action. So this year right here is 2020, and this is 2021, which we're currently in right now. Okay, so at A right here, we have an A point. Now look at what we have at A. At this point right here, we have this red candle. And again, remember, red candles are bearish candles. So this large red candle right here, okay, is our demand zone. So if I was to mark this out, we can call this our demand zone. So this is demand, all right? So in this area is where you'd, anywhere within this gray area right here would be good places to buy. If you notice, the price gradually starts to make its way up. And before you realize, we have a very dramatic rise all the way up to this B point right here, okay? So here is demand, very, very simple, okay? So this is our demand area, okay? From the weekly time frame. So this is a weekly demand zone. All right, now at B, up here, we have this area. Now, there is some prerequisites here and some things you need to keep in mind. When you're drawing the last bullish candle before the price changes direction, this swing point right here is higher than this one, okay? So when you're drawing, you can actually use the one beforehand to represent it, or you can draw it right here. Now, sometimes these wicks are deadly in the sense that they're so long that you don't even get to see supply, or you don't see any blue candles in this area where you should do. So what you're going to have to do is use the candle beforehand. The candle before would give you a big picture of what the supply is anyway, okay, in most cases. And I'm glad this example is here for you to see the picture. Okay, so we have this movement right here from A to B, and then from B downwards to C. Okay, now, according to what the market structure says we should do, so if I just reel it back over here, so currently where we are right now, so we had demand was greater than supply right here. We had a very strong movement. We've had this movement here, which is the highest price that Bitcoin has been at so far, which is about 64,000. Okay, and now the price looks like it's making its way down following our pattern. So we have two things here. Now, there is another demand zone right here. If you guys will notice, when the price went downwards here, we have this last red candle here, and then the price takes off and goes all the way up. So here, we have another demand zone. Now, you can have more than one demand zone in a trend. Usually, a trend will have multiple demand zones within it, which each of those demand zones work together to push the price upwards. So if I go right here, and I came down a bit further, you can see right here, we could actually isolate the moment where the price really starts to take off on Bitcoin near the end of the year with this demand zone right here. Again, there's another tiny one over here, which was responsible for this movement area here, right here. Okay, now you ask, how do you draw your demand zones? For me, I like to use the body of the candles only, okay, because that traps the fullness of the liquidity in the market. The wicks of the candles, all right, in another video, we'll talk about wicks, but this is what I do. Now, there's no harm in you using the full body of the candle and the wick, and if you choose to do so, you won't get marked down for it whatsoever, okay? And it wouldn't ruin your analysis whatsoever, okay? So it will just help you to be able to see things in a better view. Unless you're trading on advanced time frames and smaller time frames, then the candles and the wicks do matter. But on the higher time frames, like the monthly and the weekly, you can get away with drawing the full body and the wick. Okay. So again, we have demand is greater than supply, and therefore we have an increase in supply, in price, excuse me. When we get to B, we have an increase in the supply greater than the demand, and the price drops down. Now, right now, we're in an area of demand. So if the price was to break beneath here, okay, what would happen? If we have a break beneath this demand zone, Anytime the body, now this is where the body and the wicks matter. If the body of the candle closes beneath this area, this demand zone will become a supply area because the price was used to take the price further along, and now the price has gone beneath it, meaning that this same area is now heavily dominated by supply. So if we get this picture right here, then supply again will be greater than demand. Now, what should be our expectation based on what we see here? Now, it doesn't mean the price is going to get back down all the way here, okay? It doesn't mean that the price could stop at this demand zone over here. It could stop at that demand zone beneath here, or it can go to the primary one, which kicked off the Bitcoin bull run in the first place, which is right here. For those of you not too sure what bull run is, the bullish run in price or the an overall bullish market, okay? This is, where it started from. So when you're doing your technical analysis already, if you're watching this like me, as I'm watching this, you've already got potential targets of where the price could drop to. And if you're an investor, what if you could see the price dropping beneath here? Now, how valuable will it be to know that right here, supply is greater than demand, so the price is going to sell off. Now, if you're an investor, okay, you have deep pockets. Having deep pockets alone is not enough for you to become profitable. You need to have some sort of wisdom and tactfulness, okay? And the way to be tactful and wise in this market would be very simple. Use your technical analysis to map out the potential best prices. So for those of you who know this term, dollar cost averaging, which basically means you might not get the exact price point every single day, but overall, you want to have bought at certain price points that when you average it out and you find the mean, you get an average value of something that is within your budget. For example, if this price was at 30,000, 40,000, and 45, I really want to spend no more than 40. So I'm going to be buying at these at different price points. Some may be higher than others, some may be lower than others, and etc. And my overall average is to make sure that I keep my overall spending within an average of 40,000 per Bitcoin, for example, in this case. So right here, if we get this break beneath and the return right here, this area of demand will become supply, which means supply is greater than demand. Now, what does that mean for buying? And this is the real reason why I'm not purchasing any cryptos at the moment, because I do believe this could potentially happen. All right. If the price starts to drop here, now, as I said to you in last lesson, Bitcoin has a very high market cap compared to any other crypto that exists. Okay, about 45% of all of the 10,800 and something cryptos, Bitcoin has 45%. All right, the other 10,000 plus have 55. So if Bitcoin starts to drop short, which is another 10 for the price going downwards, all right, then we'll be looking to ride this wave down trading wise, but investing wise, it's not a good time. And so this is why you need the skill of technical analysis, because without it, you could really buy at the wrong time and sell at the wrong time, which is even worse. Okay. So in this example here, as you've guessed it, my anticipation is that somehow the price will get back down here and give us a C. Okay. And then from this C, what would happen right here? We will have demand greater than supply. Okay. And at this point, we'll be looking for the price to make its way upwards. Now, there is another rule that I want to leave you with before I get here, and is this. Coming back to market structure, I'm going to write this right here. If the length of the C to D, the length of the C to D movement, let's not put an if here. Let's just make it straight to the point. The length of the C to D movement, okay, must, all right, be greater than, okay, and this is important, guys. In part 3, I'll go through why, but this is an important rule. Must be greater than or equal to the A to B movement. All right. Now, explaining to you why right now, okay, would be a spoiler. Okay. Come to the part 3, and I definitely will describe and explain in detail why the length of the A to B movement and the C to D movement either will be equal or C to D will be greater than A to B. Okay. This is an important concept you need to understand, but keep that in your mind. Okay, guys. So I hope you enjoyed this video. Please refresh over as many times as you like. Please leave some comments. Let me know that you like the video, and I'll be throwing out more of these. Okay, and making sure that you guys have the best content to be able to really understand these markets. So I hope you guys enjoyed this video. All right. I'll see you back for part 3. Everybody take care and be blessed. I'm out.